Daniel Lacalle has joined us, Chief Economist at Actions. Daniel, nice to see you this morning.
Thank you so much.
I want to get into those forecasts from Morgan Stanley because they're quite dramatic. It effectively suggests we've gone from banking ammunition for the next crisis to ZIRP, a zero interest rate policy.
Yes.
Is that possible?
It is, absolutely, absolutely. I think that what the Fed is doing is taking preemptive action, considering what they believe other central banks are going to do and what other central banks are doing, actually. So what we're seeing basically is almost a race to zero in this environment of trying to prevent a slowdown that has very little to do with low rates. Low rates are not going to change the pace of investment or consumption.
To me, what Morgan Stanley spells out, a couple more rate cuts this year for next year, constitutes aggressive easing.
Yeah.
So how harsh should we be on Powell? Because he did not flesh out a scenario of aggressive policy easing. Instead, he called it a mid-cycle adjustment. So should we be critical of Powell at this stage, not being able to see down the line?
Well, I think that Powell has been very data dependent. And if anything, we can criticize Powell of making a rate cut that was not justified by the data, that unemployment, growth, core CPI, all of those did not justify a rate cut the last time. So what I think that Morgan Stanley and other investors are seeing is that the Fed will need to take action because of concerns about global slowdown, about the situation in Asia, the situation in the Eurozone as well, very particularly that. And I think that that's what's driving investment banks to believe that there will be more rate cuts. I think that it will be somewhere in between. I think that the Fed is not going to be as aggressive as some investment banks are predicting, but it is true that the Fed is reacting more to global concerns rather than to US data.
In terms of the Fed's power to support the market moving forward, do you think if we do get a more aggressive Fed that it's going to actually translate to stronger market sentiment? Or is the monetary policy, the toolbox that the Fed has at this point, ineffective?
Yeah, I think that it's close to being ineffective. If there's a central bank in the world that still has a few tools, it's the Federal Reserve. That is absolutely true. And we cannot forget that the dollar is the world reserve currency. Absolutely right. However, it is true that new rate cuts and even a round of quantitative easing will have diminishing effects, and they're already showing very, very clearly. You have seen rate cuts that are not translating into higher investment and easing that does not translate into higher consumption, as it should, by the way. So I think that, yes, you're absolutely right. The risk is that central banks believe that the tools that they have applied for a very specific period, which was 2008, are going to work in the end of a cycle. That's basically what it is, no?
Some of the market psychology changed as we saw that commentary from Trump around trade. Effectively, a deal is not going to be forthcoming anytime soon. The US not ready to cut a deal. But what if we see that change on a dime? And this is the problem, because central bank policy is meant to forecast further in advance than the market can effectively see. If Trump changes his commentary, cuts a deal with Xi Jinping, what do investors do? Because they could be completely misplaced on their assets.
Absolutely. I think that is one of the big risks right now, is that on one side you have a market, and that's the reason why we're selling off so aggressively, a market that was very skewed to the very cyclical stocks based on the idea that there would be an imminent trade deal and that everything would sort out very quickly.
Plus easing as well.
Plus easing. So it was almost like a massive bet on beta based on the idea that things would very rapidly change to help the most cyclical side of the risky asset base. However, that did not happen. So what can change? What can change actually is a change of tone between the US and China, a more friendly approach to the negotiation, but not a deal. It is virtually impossible to reach a deal at this stage, considering that China is unwilling to change many of the things that have led the United States to put the tariffs, and the US is not willing to back down on those tariffs now that it's pretty evident that things are not going to change dramatically.
Thank you very much for that. Our guest host today, get involved on Twitter. Lots of loyal followers out there and very active. So send us some questions and get involved in the conversation this morning.